97% of traders who start with a small account lose it completely within the first 30 days, and the reason has almost nothing to do with the market itself. This video breaks down exactly how a $50 account grew into $5,000, revealing the exact risk rules, the exact strategy, and the exact mindset shifts required to survive the brutal first few weeks. If you have ever wondered whether small account trading is real or just another lie sold online, this is the proof and the blueprint you need to watch until the end. Most beginners don't blow up a $50 account because the market is impossible. They blow it up because the account is so small, every move feels personal. One red candle feels like a verdict. One green candle feels like proof. And that's the trap we'll keep coming back to here. The real danger isn't the size of the account. It's what that size does to your decision-making. Here's the thing. When a small account starts moving, the math stays small, but the emotion gets loud. A $2 loss shouldn't feel dramatic, but when your whole account is $50, it suddenly feels like the market just took something from you. That's when traders stop reading price and start reacting to pain. And once the trade becomes emotional, the plan usually disappears next. Every dollar in a small account carries more psychological weight than it should. You might tell yourself you're only risking a few bucks, but your brain doesn't always treat it that way. It sees the balance shrinking and wants control back immediately. That pressure can turn one normal loss into a bad second trade, then a worse third one. The account doesn't collapse from one mistake. It collapses from the reaction. A lot of broke traders don't really treat Forex like a market. They treat it like a rescue plan. $50 goes in, $5,000 is imagined, and suddenly every trade has to carry the weight of a bigger life. That's too much pressure for any setup. Trading like a business starts with accepting that this is education, probability, and risk. Not a lottery ticket with candlesticks on top. But here's what almost nobody tells you. The urge to make back a loss fast is more dangerous than the loss itself. A clean stop loss is just data. Revenge trading is where the damage begins. You widen the risk, jump into a weaker setup, or double the position because you want the account back where it was 10 minutes ago. That's not strategy, that's negotiation with panic. Small accounts amplify every weakness because there's no cushion to hide behind. Bad entries, oversized positions, random exits, impatience, all of it shows up quickly. That first month isn't really a profit test, it's a discipline test. The question isn't whether you can turn $50 into $5,000 overnight. The question is whether you can follow rules when the balance is small enough to tempt you into breaking them. And this closes the loop. If a trader can't control emotion on $50, a bigger account won't fix the problem. It will just make the swings louder. The small account is the training ground. It teaches whether you can take a loss, follow risk, wait for a real setup, and not chase every candle that moves. Before the climb to 5,000 can happen, the account has to survive you first. Now that the emotion problem is clear, the next mistake happens before the first trade is placed. A $50 account doesn't have room for a sloppy setup. If the broker charges wide spreads, if execution is slow, if the platform is cluttered, the account starts bleeding before the strategy gets a fair test. The setup won't make you rich, but the wrong setup can quietly make survival much harder. Spreads matter because they're the toll booth on every trade. On Eurodollar, a small spread might barely be noticed. On a tiny balance, though, 1 or 2 extra pips can turn a decent idea into a trade that begins underwater. That's why the broker choice isn't some boring detail. It's part of risk management. Before you think about compounding, you need to stop the small leaks that drain the account first. Micro lots are non-negotiable here. A standard lot on a $50 account isn't aggressive, it's reckless. Even a mini lot can swing too hard for the account to handle. Micro-sizing gives the trader space to be wrong without making one mistake fatal. And that's the real point of the setup. Not to maximize excitement, but to keep the account alive long enough for skill and data to actually matter. Leverage is where beginners get fooled. A broker may offer big buying power, but that doesn't mean it should be used. Leverage can help a small account place properly sized trades, or it can turn one normal candle into a margin call. Think of it like a sharp tool, useful in trained hands, dangerous when emotion is driving. The ratio chosen has to protect the trader from the worst version of himself. The platform should be clean enough that a decision can be made without noise. You don't need 10 indicators arguing across the chart, 3 oscillators flashing, and a template that looks like a cockpit. For a small account, clarity beats decoration. Price, trend, key levels, risk, and the trade plan should be visible fast. If the setup can't be explained simply, it probably can't be executed calmly. Before real money goes in, run the exact setup on demo for at least a week. Not to prove you're a genius, but to expose the boring problems. Spreads widening, orders slipping, stops placed wrong, the platform freezing, or your own hesitation at entry. Demo won't copy the pressure of real money, but it can reveal execution mistakes that should never be paid for with a live account first. That rehearsal matters. Then write the rules down like a business would. What pairs can be traded? What lot size is allowed? What hours are off limits? Where the stop goes? When to stop for the day? And from the first trade forward, record everything. Entry, exit, reason, emotion, result. That journal becomes the receipt. It shows whether the account is growing from discipline or just surviving on luck and noise over time. Here's where the small account either becomes a training account or a donation. Risking more than 2% on one trade can feel harmless when the dollar amount is tiny. But 3 losses in a row changes the picture fast. On $50, every oversized loss steals both capital and confidence. The formula isn't designed to make the climb exciting. It's designed to keep one bad stretch from ending the whole experiment. The secret isn't hunting for some giant winner that saves the month. That's lottery thinking dressed up as analysis. The real job is making sure no single loss can erase a week of clean decisions. A small account grows by staying in the game long enough for good trades to matter. That means the first target isn't $5,000. It's survival with structure, because without that, compounding never gets a chance to start. Position sizing is where the math gets real. You don't choose a lot size because it looks small on the platform. You choose it by asking one question first. If this stop loss gets hit, how much of the account is actually at risk? That answer decides the trade size. Not hope, not confidence, not the last win. On a micro account, guessing the size is how traders accidentally risk 3 times more than they meant to. A fixed risk percentage takes some drama out of the decision. If the rule says 1% or 2%, the number has already spoken before the candle moves. That doesn't make trading easy, and it doesn't remove uncertainty. It just stops fear and greed from rewriting the plan in real time. When the account is small, that structure matters because emotion will always argue for something bigger, faster, and usually worse. Stop losses aren't a decoration on the chart. They're the reason the account gets another chance tomorrow. A stop doesn't mean the trader failed. It means the trade idea was wrong at that price, and the damage was contained. That's the difference between a business expense and a disaster. Move the stop because the market changed in your favor, maybe. Move it because you can't accept being wrong, and the account is now exposed. Risk to reward changes how you think about win rate. A trader can lose more often than they win and still grow if the winners are meaningfully larger than the losers. That's why a 2-to-1 setup can matter more than being right 6 times out of 10 with tiny wins and huge losses. The goal isn't to predict every candle. The goal is to build a math profile where being wrong doesn't automatically destroy progress. And this is the point that closes the loop. Every time a personal risk rule gets broken, the trade stops being against euro-dollar, gold, or the Nasdaq. It becomes a fight against yourself. The market didn't force the oversized lot. It didn't force the moved stop. It didn't force the revenge entry. Risk management is the part of trading that protects the account from the trader, and on $50, that protection is everything. Complexity won't save a $50 account. Most beginners think the more indicators they add, the safer the trade becomes. But watch what happens. The chart gets louder, the decision gets slower, and by the time everything agrees, the move may already be tired. On a micro account, speed doesn't mean rushing. It means seeing the setup clearly enough that you're not negotiating with 5 different signals at once. A better approach is to focus on a small group of high-probability setups and ignore the rest. That sounds simple, but it's hard because the market is always offering movement. Gold moves. Euro-dollar pulls back. Bitcoin rips through a level. The beginner sees opportunity everywhere. The disciplined trader sees a filter. Not every candle is an invitation. Some candles are just noise wearing a clean outfit. Trading with the trend gives a small account one major advantage. It stops fighting the broad direction of pressure. If price keeps making higher highs and higher lows, buying pullbacks can make more sense than trying to call the top. If price is pressing lower, random buy entries become expensive opinions. No trend lasts forever, but fighting momentum over and over can drain a tiny balance before the real setup even arrives. Clean price action around support and resistance often tells the story faster than a lagging indicator can. A level where price reacted before matters because traders remember it, orders cluster around it, and hesitation shows up there. This doesn't mean a line on a chart is magic. It means you're watching where buyers and sellers have already fought. For a small account, that context can be more useful than chasing a late signal. Then narrow the battlefield. 1 or 2 currency pairs are enough. A trader who watches euro-dollar every day starts to understand its rhythm, its quiet hours, its fake breaks, and how it reacts around CPI or an FOMC headline. Jumping from pair to pair feels active, but it often creates shallow knowledge. Small accounts don't need more markets. They need fewer excuses and cleaner repetition. A defined checklist removes the hesitation that quietly ruins small accounts. Before entry, the trader should know the trend, the level, the setup, the stop, the target, and the reason for taking the trade. If those pieces aren't clear, the trade isn't ready. This is for education, not signals, but the principle is universal. The checklist doesn't guarantee a win. It prevents random clicking from pretending to be analysis. And that closes the loop from the first candle to the final decision. The goal isn't to find a perfect strategy, because no setup wins all the time. The goal is to find one simple enough to repeat under pressure. Same pairs, same rules, same risk, same review. That's how a $50 account gets a fair chance, not through magic indicators, but through execution that can survive being wrong. The first $100 is usually the hardest part, not because the market changes, but because the account has almost no room to breathe. Every loss feels close to the edge. Every win feels too small. This is where most traders start forcing size because progress looks slow. But the early stage isn't about speed. It's about building enough cushion so one normal losing streak doesn't send the account right back to zero. Once a milestone gets crossed, position size can increase carefully, but only because the account can now absorb more risk in dollar terms. The mistake is jumping from micro-sizing into oversized trades just because the balance finally moved. A better compounding mindset is gradual. Let the account prove it can handle the next level. The point isn't to feel richer after one win. It's to make each stage slightly more stable than the last. Compounding in Forex rarely feels exciting at the beginning. Going from $50 to $60, then $70, then $80 can feel painfully slow when the mind is already picturing $5,000. But that's how the curve works. It starts flat, almost boring, then the same percentage gain starts producing larger dollar movement later. The danger is quitting or forcing risk before the curve has time to show its real shape. Milestone targets help because they give the climb structure: 50 to 100, 100 to 200, 200 to 500, 500 to 1,000. Each stage becomes its own project with its own risk limits and review process. That keeps the trader from staring only at the final number. $5,000 is the destination, but the account is built by respecting the checkpoint right in front of you. There also has to be a plan for protecting profits. Pulling out a portion at certain stages isn't about killing growth. It's about reducing the emotional damage of giving everything back during a bad stretch. Markets can turn quickly, especially around news, CPI, jobs data, or a surprise Federal Reserve headline. A trader who banks some progress changes the pressure. The account is no longer just chasing. It's defending what has already been earned. Sizing after wins and losses needs a rhythm. After steady growth, size can rise slightly if the risk percentage stays controlled. After losses, size should come down instead of going up in frustration. That one rule separates compounding from gambling. Winners don't justify reckless size, and losses don't demand revenge. The account grows best when position size follows the plan, not the mood of the last trade. And this is where the whole blueprint comes together. Patience isn't a motivational word here. It's a mathematical edge. Traders who rush the timeline usually reset the account before compounding can work. Traders who survive the slow phase give the curve a chance to bend upward. 50 to 5,000 isn't a straight line, and it's never guaranteed. But if the account is protected, measured, and reviewed, the climb at least has a structure it can stand on. Revenge trading feels logical right after a loss because the brain wants the account repaired now. But that's the trap. The next trade usually isn't cleaner, it's just louder. You enter faster, size bigger, and ignore the setup that was supposed to protect you. One loss becomes a second loss because the goal changed. You're no longer trading the market. You're trying to erase a feeling. Then, the opposite trap shows up after a winning streak. A few clean trades can make a trader feel like the market finally makes sense. That's when rules start bending. The stop gets wider. The entry gets earlier. The lot size creeps up because confidence feels like evidence, but confidence is not a strategy. Winning can be dangerous when it convinces you that risk stopped mattering. Comparing your account to screenshots online is another quiet account killer. Someone posts a massive gain, leaves out the drawdown, the deposit size, the leverage, and the losses that came before it. Now your steady progress feels embarrassing. That pressure pushes traders into timelines that don't belong to them. A $50 account doesn't need someone else's highlight reel. It needs its own process. Checking the balance every 5 minutes makes the account feel like a live scoreboard. Up $2, you feel smart. Down $3, you feel behind. That constant emotional feedback can push you into trades that were never part of the plan. The chart should drive the decision, not the account balance blinking on the screen. Watch the setup, review the risk. Let the balance be the result, not the trigger. Fear of missing out is especially brutal in Forex because price can move fast around news, gold, CPI, or a sudden dollar spike. You see the candle run, and the mind says, get in before it's gone. But late entries often carry the worst risk. The move already happened, the stop becomes awkward, and the setup no longer matches the plan. A good trader knows that missing a move is cheaper than chasing a bad one. The most dangerous sentence in a small account is, just this once. Just this once, ignore the stop. Just this once, hold through the spike. Just this once, add more because it has to come back. Markets don't reward that kind of hope. A stop loss exists because every trade carries risk and the account needs a hard line. Remove that line, and the trade can turn from a planned loss into an account problem. This is why journaling emotion matters as much as journaling price. Write down whether you felt rushed, angry, bored, confident, scared, or desperate before the trade. Over time, patterns appear that the profit and loss column can't explain. Maybe your worst trades happen after wins. Maybe they happen after news. The journal closes the loop. The real trap isn't emotion itself. It's trading while pretending emotion isn't there. High-impact news can turn a careful week into a chaotic minute. CPI, the jobs report, an FOMC statement, or a surprise dollar move can make spreads widen and candles jump through levels before a beginner even reacts. That doesn't mean news should be feared. It means news needs a plan. Trading into it without rules is like stepping onto the highway because the light looked green just a second ago. After a few wins, the account feels different. The trader feels smarter. The temptation is to raise size quickly because the last setup worked and the next one should work too. That's the classic turn. A good streak becomes a bad month because the risk expanded faster than the skill. Growth has to be earned in steps. If position size jumps because of excitement, the account is no longer compounding. It's drifting. A losing streak is information, not an insult, but beginners often treat it like something to push through. They keep trading the same way, at the same speed, with the same frustration, hoping the next entry fixes the pattern. That's how small failures compound. A pause is not weakness. A review protects the account from repeating the same mistake until the balance is too damaged to learn from it. Correlation is one of the quiet ways traders double their risk without noticing. Long euro-dollar and short dollar-yen may both be bets against the dollar. Gold and certain dollar moves can overlap too. The screen may show different charts, but the account may be exposed to the same idea twice. On a small account, that matters. Two trades that look separate can act like one oversized position when volatility hits. Boredom trading is expensive because it usually enters without a real reason. The market is open, the chart is moving, the account feels too quiet, and suddenly a weak setup starts to look acceptable. That isn't analysis. That's entertainment with risk attached. A small account can't afford trades taken just to feel active. Some of the best decisions a trader makes will look like nothing happened because no trade was the trade. Skipping the journal removes the evidence. Without records, every loss becomes a story, every win becomes talent, and every mistake gets easier to forget. A journal turns opinion into data. It shows which pairs behave best, which sessions cause problems, which setups actually pay, and which emotions keep showing up before bad trades. The trader who refuses to track the process is choosing to stay blind. The last mistake is quitting right before the process starts to work. The early curve can feel slow, ugly, and unrewarding. Then one disciplined month starts to create better habits, cleaner risk, and more useful data. But many traders reset the account before that stage arrives. The lesson isn't that $50 will become $5,000. There's no guarantee. The lesson is that the account can't grow if the trader keeps abandoning the rules. If this breakdown changed how the next trade gets approached, that's the point of trader press. Not hype, not signals, not another screenshot pretending risk doesn't exist. This channel is built for traders who want to understand market behavior, structure their decisions, and stop treating every candle like a personal emergency. Subscribe and turn on notifications, because each week brings another step-by-step lesson without the recycled noise. Drop a comment with the current account size and the goal being chased, $50, 500, 5,000. The number matters less than the process behind it. That comment could become part of the next account journey we break down on the channel. Then watch the next video, because it explains the risk management mistake that quietly destroys most small accounts before they ever get the chance to grow.